Sometimes a single day can feel like an entire era in the world of tech and finance. Well, we just lived through one of those days. It was this absolutely chaotic collision of market meltdowns, AI hype, Wall Street, well, invasions, and these really deep philosophical fights over the future of money itself. Okay, let's get right into it. Everything really kicked off with this one number, $227 million. Just imagine seeing that figure pop up. It's huge, it's stark, and it's just kind of hanging there. So, what on earth does it mean? Well, that's how much money in optimistic, bullish bets got completely vaporized, wiped right off the market in just a few hours. It was a brutal, sudden reminder of the kind of volatility that set the stage for this entire day of reckoning. And that brings us to the first scene of our story, just pure, unadulterated market mayhem. The day started with what looked like this amazing, triumphant surge for Bitcoin, right? But that celebration, it did not last long at all. I mean, the speed of this move was just stunning. First, you see Bitcoin blast right through the $124,000 mark. And then, just hours later, a total faceplant, plummeting below $117,000. That's the swing that liquidated all that leverage and sent a shockwave through the entire market. So while all that chaos was happening in the markets, a totally different kind of battle was kicking off, a real fight over what innovation even looks like anymore. And it played out in two completely different arenas: AI software and crypto hardware. On one side, you had let's call it a messy debut of GPT-5. The internet, of course, immediately jumped on these simple, almost funny errors. This one right here, claiming 9.11 is greater than 9.9, it became a meme almost instantly. And it just fueled this huge wave of criticism. But here's the thing, right? The real story isn't the error itself. It's the reaction. The outrage actually tells us a lot more about our own ridiculously high expectations for AI than it does about the tech's actual progress. We've started demanding perfection, so when we see these kind of boneheaded flaws, the backlash is just ferocious. It's where perception and reality have this violent collision. And while literally everyone was loudly arguing about GPT-5, Jack Dorsey's company, Block, was making a move that was the total opposite of all that flashy software hype. Nope, they were focused on the foundation. The plumbing. See, to really get what they're doing, you have to understand the problem they're trying to solve. For years, crypto miners have been stuck in this painful cycle of buying expensive hardware and then watching it become obsolete in like 3 to 5 years. It's a constant cash burn. Block's big idea? A modular system. Rigs built to last for over a decade. This has nothing to do with hype. It's about building sustainable, long-term infrastructure. A completely different kind of bet on the future. Okay, so let's shift gears from the builders to the bankers. The next major battlefront of the day was this undeniable invasion of Wall Street into crypto. We're talking institutions making absolutely massive moves to plant their flags and claim their territory. First up, bullish, the digital asset exchange. It priced its IPO and landed a staggering valuation of $5.4 billion. And you had giants like BlackRock and ARK showing early interest. That's a huge signal. Then you have Pantera Capital, a huge fund revealing they've poured over $300 million into crypto treasury companies. Now, that's a strategic play. It's about growing their crypto holdings over time, not just buying and sitting on it. And then, maybe the most audacious move of all, the Bitcoin mining company BitMine announced it plans to raise a mind-boggling $24.5 billion for one reason: to buy more Ether. This is the corporate race to accumulate crypto assets heating up to a whole new level. So look at these. They're all different angles of attack, right? You've got IPOs for access to public markets, you've got strategic treasury investments for steady growth, and then just aggressive direct accumulation. Big money is not just dipping a toe in anymore. They are deploying seriously sophisticated, multi-pronged strategies to get in. All this new money, all this new tech, it forces what is maybe the most important question of all: who gets to write the rules for this stuff? And that brings us to our final battleground, this deep, ideological fight over the future of the financial system itself. On one side of this war, you have a problem that's kind of baked into crypto's DNA. This number, $1.8 billion, that's how much value has been maliciously siphoned away from Ethereum users. It's a staggering figure, and it points to a really fundamental vulnerability. So this problem, it has a name. It's called malicious MEV. Basically, because Ethereum's transaction pool is so radically transparent, Bad actors can literally see your trade coming, and they can strategically place their own trades to profit from yours, which is basically a high-tech way of front-running and, well, stealing from everyday users. And this brings up a really, really tough question. I mean, the whole point of crypto was to be this open, trustless system, right? But is that radical transparency actually worth it if it creates a hunting ground where regular users can lose billions of dollars? Now, on the complete other side of this rules debate, you have the old guard. The U.S. banking lobby is out there actively fighting against new things like yield-bearing stablecoins. Their claim? That these new financial products could destabilize the entire traditional banking system. Which, of course, leads you to ask the obvious question. Are they genuinely concerned about systemic risk here? Or are they really just afraid that stablecoins, which can offer way better returns than a savings account, are going to eat into their business model? It's that classic battle, the incumbents versus the innovators. Okay, so after a day filled with market crashes, AI drama, big hardware bets, billions from Wall Street, and these regulatory wars, what's the real story? What does all this chaos actually add up to? When you really boil it all down, the entire day was defined by these three core battles. You had the flash and hype of software fighting against the slow, steady reality of hardware. You had the raw capital of Wall Street colliding with the original ideals of crypto. And then this huge philosophical clash between radical open transparency and traditional centralized control. And that leads to the main takeaway from all of this. This isn't just random noise. This is not the chaos you see when an industry is failing. No, this is the necessary, messy, and really loud chaos of an industry that is maturing, fighting its way from the fringes of the internet right into the center of global finance. Which leaves us all with the ultimate question, doesn't it? As these two massive worlds, technology and finance, continue this epic collision, all of these little battles are really just skirmishes in a much larger war, a war to decide just one thing: who gets to write the rules for our financial future?